The Four Pillars of Investing by William Bernstein is a comprehensive guide to building a solid investment strategy aimed at both novice and seasoned investors. Bernstein, a neurologist turned financial theorist, provides a unique and insightful perspective on the complexities of investing, focusing on four main pillars: theory, history, psychology, and business. These pillars form the foundation of his investment philosophy, emphasizing the importance of understanding the broader context of the financial markets and human behavior in making informed investment decisions. Pillar 1. The Theory of Investing. The first pillar delves into the theory of investing, laying the groundwork for understanding the principles that drive market behavior. Bernstein begins with an explanation of how financial markets operate, introducing readers to concepts like risk, return, and the relationship between the two. He emphasizes that risk and return are inseparably linked. Higher returns are generally associated with higher risk. Understanding this relationship is crucial for investors aiming to build a portfolio that aligns with their risk tolerance and financial goals. Bernstein introduces the efficient market hypothesis, EMHA cornerstone of modern financial theory, which posits that all available information is already reflected in asset prices. This theory implies that it is nearly impossible to consistently outperform the market through stock selection or market timing. As a result, Bernstein advocates for a passive investment approach, such as index investing, where one aims to replicate the market's performance rather than trying to beat it. In discussing portfolio theory, Bernstein explains the concept of diversification, spreading investments across various asset classes to reduce risk without necessarily sacrificing returns. He introduces the idea of the efficient frontier, where a portfolio is optimized to achieve the highest possible return for a given level of risk. Bernstein also covers asset allocation, the process of dividing investments among different asset categories like stocks, bonds, and cash, which is one of the most critical decisions an investor can make. Pillar 2. The History of Investing. The second pillar focuses on the history of investing, underscoring the importance of learning from past financial events. Bernstein takes readers through a historical journey, highlighting significant market events and their implications for investors. He covers the Dutch tulip mania of the 1630s, the South Sea Bubble, the Great Depression, and more recent market crashes, illustrating how irrational behavior and speculative bubbles have repeatedly led to market collapses. Through these historical examples, Bernstein emphasizes the cyclical nature of financial markets. He argues that understanding history is essential for recognizing patterns of market behavior and avoiding the pitfalls of past mistakes. By studying the history of financial markets, investors can better anticipate potential risks and develop strategies to mitigate them. Bernstein also discusses the role of governments and central banks in financial history, particularly their influence on market cycles through monetary policy. He highlights how interventions, such as interest rate adjustments and quantitative easing, have shaped financial markets over time. This historical perspective helps investors understand the broader economic forces that can impact their portfolio. Pillar 3. The Psychology of Investing. The third pillar explores the psychology of investing, which Bernstein considers one of the most critical and challenging aspects of successful investing. He explains that human behavior often deviates from rationality, particularly in the context of financial decision-making. Cognitive biases, emotional responses, and herd behavior can all lead to poor investment decisions, even among experienced investors. Bernstein delves into various psychological biases that affect investors, such as overconfidence, loss aversion, and the tendency to follow the crowd. Overconfidence, for instance, can lead investors to overestimate their ability to predict market movements, resulting in excessive trading and increased risk. Loss aversion, on the other hand, can cause investors to hold on to losing investments for too long, hoping to avoid realizing a loss. One of the key takeaways from this pillar is the importance of maintaining discipline and sticking to a well-thought-out investment plan, even when emotions run high. Bernstein advises investors to be aware of their psychological tendencies and to create strategies that minimize the impact of emotions on investment decisions. For example, adopting a long-term perspective and avoiding frequent portfolio adjustments can help mitigate the effects of short-term market fluctuations. Bernstein also emphasizes the value of humility in investing, acknowledging that no one can predict the future with certainty. By recognizing the limits of their knowledge and avoiding the temptation to chase short-term gains, investors can improve their chances of achieving long-term success. Pillar 4. The business of investing. The final pillar addresses the business side of investing, focusing on the investment industry itself. Bernstein offers a critical view of the financial services sector, highlighting the potential conflicts of interest and hidden costs that can erode investors' returns. He argues that the industry often prioritizes its own profits over the best interests of its clients, making it crucial for investors to be informed and vigilant. Bernstein discusses the various types of financial products and services available to investors, including mutual funds, exchange-traded funds, ETFs, and financial advisory services. He warns against the allure of high-fee investment products, which can significantly reduce long-term returns. Instead, he advocates for low-cost index funds and ETFs, which offer broad market exposure at a fraction of the cost of actively managed funds. The author also emphasizes the importance of transparency and understanding the fees associated with different investment products. He encourages investors to carefully read the fine print and ask questions about the costs involved in managing their portfolios. By being aware of these costs, investors can make more informed decisions and avoid unnecessary expenses that could detract from their investment goals. Bernstein also touches on the role of financial advisors, noting that while some advisors provide valuable guidance, others may be more focused on generating commissions than on serving their clients' best interests. He suggests that investors seek out fiduciary advisors who are legally obligated to act in their clients' best interests and who offer transparent fee-based services. Conclusion. In the 4 pillars of investing, William Bernstein provides a holistic approach to investing, combining theoretical knowledge, historical context, psychological insights, and practical advice on navigating the investment industry. His emphasis on the importance of understanding the broader context of financial markets and human behavior sets this book apart from other investment guides. Bernstein's central message is that successful investing requires more than just picking the right stocks or timing the market. It requires a deep understanding of the underlying principles that drive market behavior, a historical perspective to avoid repeating past mistakes, an awareness of the psychological traps that can lead to poor decisions, and a critical eye toward the financial services industry. By mastering these 4 pillars, investors can build a robust investment strategy that is well suited to achieving their long-term financial goals while minimizing risk and avoiding common pitfalls. Bernstein's book serves as a valuable resource for anyone looking to improve their understanding of investing and make more informed decisions in the pursuit of financial security.